All right. Out of respect for everybody that made it on time, we're going to kick off on time. So I want to introduce Katie. There's a couple housekeeping things I want to cover first, but Katie is joining us from Colorado. She is awesome. We've been working together with her for a couple of years, and she helps a lot of our clients all over the country. She'll tell you a little bit more about her in a minute, but she has been doing accounting for longer than I've been alive. Just kidding, Katie. But she's been doing it for 20 years or so, 21 years, and excellent resource for us. We're excited to have her share some knowledge today. Do you mind going to the next slide for me real quick, Katie, to show the Slido? Because of the nature of the call, we are not allowed to do live questions. So we can't have you raise a hand or pipe in, but what we have is this resource here called Slido. So if you open a website or on your page, on your phone, you can actually type in sli.do, hit enter, or go to slido.com and enter event code CPA Katie. This will be on the bottom of the slides as we move along. But it works, it's a live feed, so you can ask a question in there. I'll be monitoring it as we go along and Katie's talking. And if you see a question that somebody else asks that you like, you can thumb up it and it'll push it towards the top of the list of questions. So with that said, I'll get it over to Katie. There'll be a reminder on the slides as we move along if you want to ask questions. So keep that open as we're moving along. And Katie, I'll turn it over to you.
Awesome. Thanks, Ian. I appreciate it.
You're welcome.
Thanks for inviting me and having me today. Ian and I got connected through a mutual client that might be on. So hi, Greg. I am grateful to have the opportunity to just chat and give you a little bit of feedback on kind of what we're seeing this year and coming down the pike, probably on some tax reform. So feel free to put those questions in the Slido because that'll help me kind of navigate where the items that are important to you or are on your mind. And feel free, pass out my information later on. You can always reach out with questions later as well. But just to get started, this is my favorite quote. I use it all the time with my clients. And the only thing that hurts more than paying income taxes is not paying income taxes. So to be honest, when I have a client, I want you to make $1 million and I want you to have a tax bill. I'm just here to mitigate it and to help you pay as little as you possibly can under the constraints of the law, right? But if you don't have an income tax and you don't need me, then that's a worse place to be. So that's Ian said a little bit about me. I've been with this firm for about 21 years. My dad actually started the firm and I bought him out in 2006 when he retired. So I'm one of the 4 tax partners here, but I specialize mostly in small business planning, do a lot of real estate, but I also do 401k plan administration for small business and setting up plans, figuring out how to run them, costs, and doing all kinds of day-to-day stuff for that. So that's a fun piece of the business. Anyway, so to get started a little bit, now that we have a new president, of course, all we talk about here on the news is what's coming down the pike and all of the tax reform that's coming our way and what's good, what's bad. A few things have gone into play already with the infrastructure bill, some of the COVID planning that they've already been doing. Some of the big things, let's move here. So some of the stuff that's already happened, of course, we've had the COVID Family Act that has come through, which has started up some additional child tax credit payments, advanced child tax credit payments that are coming out to everybody. Those started getting paid out in July of this year. So they might have hit your pocketbook already. So if you have under a certain amount of income and kiddos under 17, they're going to bump up the child tax credit and prepay half of it during the next 6 months. And then you'll get the other half on your tax return like normal. The one thing to kind of bring up here is that for those folks that are over the income limit, which in my head is about 195, I'll have to look and make sure, but if you're going to exceed that limit, if they prepay you for your kids during this year, you would potentially have to pay it back on your tax return. And it's a little bit concerning for those people that are just getting random checks and they're kind of in that ballpark of maybe going over the income limit. If that's you, you can opt out of the advanced child credits and have them not pay you over the 6 months. Then if you do qualify, you can get it on your tax return. But it's something I'm kind of telling my clients to make sure you look at because you don't want to have to be ponying up, $2,000 a kid at tax time to repay credits that you weren't eligible for. So there is a calculator on the IRS website at irs.gov. If it's concerning, you can go in and pop in and see if there's anything that you should do. That's kind of the only thing right now that's actually in place. Most of this stuff on this page that I've got listed up on here is stuff that's kind of in the works. So Biden's tax package has been revamped about 15 different times. The numbers change a little bit here and there, but the biggest changes that we'll talk about are kind of going back to pre-Trump tax brackets. It's not a big hike. We would just go back to what the rates were during Obama. Right now, the top tax bracket is about 37% at incomes of 518. They're going to take that back to the top bracket at 39.6, which is what it was pre-Trump. The kicker is they're going to lower the size of the brackets. So right now, we've got 518,000 to get in the top bracket, and they're going to lower it probably down to about $400,000 to kick you into the top bracket. The interesting piece and really frustrating piece is that we can't get an answer from the tax guys as to whether that $400,000 is a individual amount or a married filing joint amount. So we don't know if that's a $400K for two people or $400K for one person. They haven't told us, and we've asked and no answers. So we're a little concerned that it's going to be $400K for a married couple. If it's not, then it's going to make perfect sense to not get married in the future and have the ability to have $400,000 tax brackets per person. But I have a feeling that's probably not the case. We think it's probably a married tax bracket, but we don't know. Kind of one of the big changes and one of the more concerning changes revolves around capital gain taxes and estate taxes. So on the capital gain side, right now, you get a preferential treatment for long-term capital gains of either a 15% bracket or 20% bracket, depending on all of your other income. They're talking about leaving those 15 and 20% brackets, but if your income exceeds, they've now bumped it to $1 million. So this slide is out of date. They were going to take it if you had an income of $400,000, they were going to make you pay at the highest tax bracket for your capital gains. They have now moved that dial to $1 million. So you can now have $1 million of other income. If you do, your capital gains are going to be taxed at the highest tax bracket instead of at the preferential 15 and 20% like they are now. So that's going to be a pain point for some people. It could be a pretty heavy pain point. For planning purposes, we're just saying, if you've got some gains to harvest, you may want to think about it in 2021 while you still have preferential rates, if your tax bracket's going to be in that over $1 million mark, or do some tax planning just to make sure we can mitigate that. Net investment income tax right now is if you make over $250,000 and you've got investment income, you're paying an additional 3.8% Medicare surcharge. That was the payment to pay for Obamacare and the fee that came in with Obamacare. Right now, that net investment income tax is paid kind of on those investments over 250. They're talking about increasing that number. 3.8% would remain the same, but instead of just on investment income, if you make over $1 million, they're going to charge you that 3.8% excess Medicare on all of your income. That could be huge. So that could be a pretty big, bump increase in excess of your high tax bracket. So essentially they move you from a 39% bracket to almost a 44% bracket just by taxing that investment income, your additional income in excess of $1 million for that 3.8 investment tax. So that's a big one. C Corp income tax rates, we hear about that a lot on the news. And so right now they're at 21%, which is the lowest they've ever been. They were at 35% pre-Trump, and we're probably going to move the dial a little bit. They want to take them up to 28% for C Corps, but they're not going to go back to the full 35%. Where that kind of affects us is gross domestic product, the calculation of GDP, factors into the large C corporation earnings and profits, which eventually, flows down to us the little guys based on, how good the economy is doing, essentially. That one's probably not too much of a big deal. The C corporations have different ways to manipulate their tax bills, so that one's not probably huge and probably doesn't affect a lot of us, except for the fact that if you own stock, A corporate income tax rate, a higher corporate income tax rate will mean lower earnings, which could potentially mean lower dividend payout, or lower stock prices or something like that. So it's not a big, touch point to us personally, but it is on the investment side of things. Some of the fun things coming down the pike on real estate, by fun I'm being facetious, is 1031 exchange options have always been available that you could postpone or defer your tax bill when you sell a property, an investment property, if you bought another investment property and invested the dollars. So if you had a rental, sold that rental, bought a new rental, you could defer the gain taxation on that rental property until you sold the replacement property. They're now talking about, originally in the new original Biden plan, it was talking about getting rid of that altogether. They've now kind of pulled back the reins a little bit, and now they're saying we're going to potentially just disallow 1031 exchanges for any assets or any gain in excess of $500,000. So if you've got a building where you've got a gain of $1 million, you can only defer $500,000 of the gain into a new investment property, and you have to pay tax immediately on the others. It used to be you could defer as much as you wanted to. So that one is an interesting one. We're not sure that one's going to pass. The real estate folks, they've tried it a couple of times. In the 80s, it failed miserably and they put it back in. So I'm not sure if that one will actually come to fruition, but we'll see. Probably some of the two biggest ones that are on people's minds right now, and is a real challenge for us in the industry and for attorneys, is they are definitely probably going to take the estate tax exemption back to some pre-Trump rates. Right now, if you pass away, each individual has an allowance of $11.6 million worth of assets that they can pass on to their heirs with no estate income tax. And that number is considerably higher than it has ever been. It was about 6.5% prior to Trump. And we're pretty sure that that one's going to get pulled back. That's kind of one that both sides of the aisle can agree on. And so what we don't know is where is it going to get pulled back to? So we've had some analysts say they're going to pull it all the way back to $1 million or $2 million, where you could transfer assets of $1 million or $2 million to your children with no tax. Anything over and above that would be taxed at your death. Probably the majority of the thought process is it's going to go back to pre-Trump rates, which would be Obama era, so 5 or 6 million. We think probably that is something to plan on, the $5 or $6 million range. And what that means is that, if you do have assets anywhere near that mark, you need to start worrying about estate planning again. So if you have assets in excess of $5 million, the estate tax is about 45% at the moment. They're talking about raising that to where it would be 55 to 60%. And so estate planning on a high net worth estate is important because we don't want to give any away to the government. We want our kids to be able to inherit it. So some of the things that we can do to mitigate that would be gifting over your lifetime, giving some money to your kids while you're still here, using your lifetime exemption for gifting, passing it to grandchildren and taking advantage of generation skipping type gifting, and just trimming back your estate if you can get it under that $6 million mark. You do have a double exemption if you're married, so you have maybe $10 to $12 million if you're a married couple. But it's something to definitely think about. When it was 22 million, for a married couple, it wasn't that big of a deal. Most people were going to be well below that, but you'd be surprised how many people eke up there when it starts getting to that, 5 million for one person, 10 million for two people. So it's something to talk about with your estate attorney. The trust planning may come into play where we can put money into a trust now for kiddos that gets that money out of your estate. You can transfer assets. Stock is a great one. You can, talking to Ian about transferring some in-kind kinds of things to heirs is a kind of a fun opportunity as well.
Katie, real quick question. Is there kind of a rule of thumb that you like to think on an age for some of that gifting stuff? Because if you're 30, you might not be thinking, do it. If you're, 80, maybe take advantage more aggressively. What kind of thought process do you put into when age, life expectancy type of stuff would you really push the pedal on getting that done?
Yeah, I think number one, it depends on who you're gifting to. So if we're talking about children, you don't want to be gifting to them while they're minors. They can't take that kind of gifting. It essentially doesn't leave your estate. There's some weird rules around that. So your children need to be of age, so over 18. But you can do charitable gifting and that kind of thing, where the age kind of comes into play. A 30-year-old might need it if they are already at that $12 million mark and they've got 60 more years of earning potential. Chances are they're going to have a problem regardless. But, really it's more of where are your assets and what are your holdings and what's your, level of net worth. So until you're kind of approaching within maybe $500,000 of what that limit is, it may not be something that you need to be worried about now. So not necessarily. Older folks are probably going to have a bigger problem just because they've had all of those years to save and they've had those larger earning, years where they might have a problem.
Yeah, and I think we hear a lot of hustle and bustle around like hurry now, time's running out, and it kind of, the rules change all the time and there's ups and downs and backs and forth and ebbs and flows. This is a really good opportunity, I think, because we haven't seen those limits so high. But also you're making some irrevocable gifts of money out of your world at the same time that we have to keep in mind. So just thanks for answering.
Yep, all of that is true. It's not a one size fits all. It's really going to depend on your situation and your estate plan for your heirs as well. I think one thing to caveat all of this is, they've been talking about when is all of this going to go into effect. Earlier in the year, I would have said probably by the end of 2021, and we were kind of more on an emergency planning type phase. Now the AICPA and kind of the lobbying agencies in Washington are telling us, probably not 2021. And now we're thinking maybe not even 2022. Having tax hikes, whether they're, regardless of who they're on, does do some a little bit of damage to the economy. So when the economy is already feeling a little bit stale or if inflation's a little bit painful, it doesn't always make sense to have this tax reform come in right away. So now it's already being talked about that maybe they would do a forward-looking tax plan that could even be 2023 or 2024. So until the trigger gets pulled, all of this is just really prospective, and we're just trying to keep our finger on the pulse so that we're not shocked by it. But who knows if it could happen, and probably not going to happen this year in all reality. Going back on the bottom of this slide, so in the Trump tax reform for small businesses, for any business really that had, it was a qualified business. So typically a self-employed person, small S Corps, small partnerships that were not personal service corps, such as doctors and attorneys and accountants. Trump put in this deduction called the qualified business income deduction, which was up to 20% of your net income is tax-free, essentially, if you're under a certain dollar amount of income. Right now, it's on the docket that they would probably eliminate or scale back drastically that QBID deduction. So the nice, tax bills we've had on business income for the last few years could change, just because that's probably going to go away as well. But moving on a little bit, some of the positives, again, we've talked a little bit about the increased dependent credits, and those things have already been pushed out. They're talking about putting in a first-time home buyer credit, again, that's refundable up to $15,000 that you don't have to repay like you did back in the Obama credits. On the very low income earner side of things, there's some renters tax credits in there for paying rent and utilities over and above a threshold. Trying to even the playing field at poverty level. So if you're more than 400% above poverty level or under, then you can get some of these credits for paying your rent and utilities, that sort of thing. They expanded the earned income credit, which is basically just a free money gimme refund at the end of the year for folks that are over 65 but don't have children. Prior to that, to qualify for the earned income credit, you had to have earned wages and kiddos. Now you can be retiree, have earned income, and still qualify for that earned income credit. They're probably going to make that a permanent fix going forward. Helps those that are actually still working in their retirement years, gives them pretty much most of their tax payments back if they're under a certain level. They're going to increase the Obamacare premium tax credits to make health insurance premiums more affordable. So currently, those under 400% of the national poverty level, that number is about $65,000 for a married couple. If you're under that $65,000 mark, you can get premium tax credits by purchasing your insurance through the exchange. They are probably going to make the credits a little bit more robust. So it'll cover more of the insurance premium. So essentially paying for your health care is what that one does. The one that affects probably more people, and it'll affect all of us, not just the upper incomers or the low incomers, is removing the $10,000 state cap on state tax deduction. If you remember, when that went into effect, the states that pay a lot of income tax were in an uproar. In New York and California, where your state income tax can be huge and your real estate taxes are huge, capping that $10,000 deduction on your itemized deductions was a big deal. People had a big tax hike simply from this one piece. So they're going to repeal that $10,000 state income tax cap. So you can now deduct all your state income tax paid, all your real estate taxes, and all of your personal property tax, license plates, and those types of things. And it had that included back in your itemized deductions. This one change alone will probably shift the practice that most people right now are not itemizing their deductions. They're taking the standard deduction. When this goes away, it'll probably swing the pendulum back to where more people will be itemizing because they're paying a lot of state income tax or real estate taxes. So that one's going to be a big one, and actually a pretty nice tax cut for everybody across the board, regardless of income status. There's a few things coming down the pike on the retirement plan changes. Some of them are big and some of them are not, but since this is kind of my baby and my passion, I like this piece of things. Right now, if you put in a 401k plan or even a simple or set plan for your employees, if you're a business owner, you can deduct your cost of putting that plan in up to $500 for 3 years. And they're going to probably increase that to where it's either a higher number or a longer period where you get a tax credit for basically having that plan in place, which covers your cost of administration. They're going to provide additional credits to low income taxpayers for putting money into their retirement plans. So if you have if you're under that income threshold, you do get a retirement savings credit now, but that income threshold is very low. So they're going to increase that threshold to where more people will get a credit for actually saving and putting money into their 401k at work. The real stinker that's on here is that they are going to potentially eliminate the tax advantage of making a 401k contribution if you are a high income earner over $400,000. So now currently those of us in that high level get to deduct their $19,500 worth of 401k contributions like everybody else. It offsets your taxable income if you put it into a pre-tax contribution format. And that would go away altogether if your income is in excess of $400,000. You can still contribute into the 401k plan, but you don't get a tax break for doing so, which is kind of stinky because they want us to save, but then they don't reward you for doing so. So it is what it is. I think that's probably the big things there. Just some things on the stimulus payments. We don't anticipate they're going to do another one. There had kind of been a little bit of talk here and there about sending out another check. I think that's been stymied. I'm not sure it's going to happen. But just to bring up the $1,400 payments that did go out earlier this year, your tax preparers will need to know about those. And the one thing that was different this year as opposed to prior years is as long as you were under the income threshold, they gave that $1,400 stimulus payment to every single person on your tax return, regardless of age, where the prior year, the 2020 stimulus payments were only paid for kiddos under 17. The income limits were similar, but if you had children on your return that were over 17, you didn't get a stimulus for those that did not work that way in 2021. The $1,400 got paid out to every single person, regardless of age, that was dependent on your return. So again, they're not taxable, just like they weren't in 2020. They're just a prepayment of a tax credit on 2021, but we'll need to know how much everybody received in order to make sure your return is done correctly. And then if you didn't get one and you're eligible, you'll get it as an additional refund, just like 2020. If you became eligible during the year, had a low income year or something, you can always get more of that 2021 stimulus as part of your refund package. All of this just to say, make sure you tell your tax preparer about it when you get your taxes done next year. So some of the things kind of coming down.
Real quick question for you. Is there any news on rent relief? I know there's a lot like landlord rent relief type of stuff. They keep deferring payments and other things, but I was reading something that like 90% of the funds allocated for rent relief haven't been distributed yet. Have you heard anything about game plan for landlords that have been kind of eating it for the last year and a half?
Ian, honestly, not on the tax side of things, not, for instance, it wouldn't be a credit or something that you could use on your tax return. Almost all of those rent relief pieces have been filtered down through state agencies. So you've got to go and actually apply and,
Gotcha.
Qualify and get relief through those state agencies. So I don't think it's going to be anything where it's going to come out as a additional credit, or they're going to filter those funds down tax related wise anyways on a tax return. But there are a ton of funds left in many different things. One thing to mention while we're talking about that on the COVID relief is the mortgage forbearance. So if you have a COVID issue or you lost a job or any of those kinds of struggles, you're allowed to request mortgage forbearance from your mortgage company for 6 months, and then an additional 6 months if you're still having a problem. So up to 12 months of mortgage payments postponed. That is set to sunset, and it ends on September 30th of this year. And so if that applies to you, or it's something that would be important to you, you need to make that happen prior to September 30, because it is going to go away. Right now, it's a no-brainer. All you have to do is tell the mortgage company I have an issue, and they have to do it. After that point, there's no more forbearance available. Just a thought. Let's see. So on this slide, some of these questions are more what's related to me if I'm a business owner as opposed to an employee. On the business owner type of thing, these are more just regular questions that happen every day, not necessarily for changes that are coming or that sort of thing. I get a lot of questions on how do I choose what type of business I want to be? I'm starting a new business. What does that need to look like? So I kind of wanted to just walk through a little bit of that if it pertains to anybody here. What you typically will hear about a lot of times is, should I have an LLC? So a limited liability company. And where things kind of go off the rails is that an LLC is a legal entity, not a tax entity. An LLC is just a kind of an umbrella entity that helps you limit your liability, hence its name. Were you to get sued, only the assets under that umbrella or inside of that entity would be at risk. And it protects all of your other assets from danger in the event of a lawsuit or something like that. On the tax side of things, an LLC gets to choose how it gets taxed. If you're a single person and opening an LLC, you're automatically defaulted to be a sole proprietor, where you just report it on your personal return. If there's two members of that LLC, you're defaulted to be a partnership. But most of the time, it makes sense to not be a partnership or a sole proprietorship. And so an LLC can choose to be taxed as an S corporation once the income makes sense to do that. So all of this to say, kind of just a thought process behind it. If this is you have a business kind of in the works, at some point, an S corporation probably would make sense for you and it'd be something to talk to your tax preparer about. There's a kind of a sweet spot where it makes sense to convert into that corporation. So it'd be a good question to ask. Interestingly, I saw some news coming down the pike this week as well, Ian, on some things that they are potentially going to close the S corporation loophole, which basically allows you to manipulate how much Social Security and the Medicare tax you pay, which is the kind of the point of doing an S corp. And so if they do close that loophole, I I would venture to say S corporations themselves may be a thing of the past or be put on hold for a little while. So if you're starting a business soon, it may be something to consider there too. But
Would you expect it to close that loop going forward, or would it grandfather existing S corps in? How would that look?
yeah, the article that I read did say that it would be an all or nothing kind of thing. So it would probably not be a grandfathered thing. I think that they are realizing how much Social Security and Medicare tax they're losing because of the S corp ability to manipulate those taxes. And so I think that it will happen, especially on the horizon of being able to fund Social Security and keep that into place. This is one super easy way to pay for that. So we'll see. It'll change the planning options for businesses widely once that happens. So we'll keep an eye on it.
Okay.
We get a lot of questions on when do I need to, contact someone to get professional help on the business? I think the CPA portion of it is always important. This is where we can be more value to you and come back and say, hey, make sure you're getting all the deductions that you should be, make sure that we're appreciating property correctly, make sure that we're picking up every dollar of cost that we're able to deduct to make sure that you're paying as little as possible. Businesses have a much bigger horizon and bigger group of things that we can do. So CPA, I think, is always important. Where the question always comes in is, do I need to actually hire a bookkeeper or a payroll company? It depends. I think if you're making enough money to be able to afford a bookkeeper, do it. The reason being is that you need to focus on whatever you do as a business owner, because that's your strength and ability, and the bookkeeper can come in and take that little piece of stress off you. I always tell people, if you're at the point where you're paying payroll, you need to have a payroll company. The laws with the new COVID stuff have changed so drastically that with the new employee retention credits that are available, if you've got COVID shutdowns and all the money that's flowing through the payroll pieces of things that employers can be eligible for, the nature of payroll, the payroll beast has changed dramatically in the last year. So if you're not using a payroll company, I would highly suggest that you get one immediately. The big guys, I don't even care who you use, the Gusto and Paychex and ADP of the world are experts in figuring out all of those fancy things and the credits and all of the things.
It's just nice when you get all those notices in the mail to be able to scan it to somebody as opposed to read it and try and figure it out.
100%. Let them handle that piece.
Quick question. Go ahead. There's a couple questions that came through. I'll ask you, but go ahead and finish your thoughts.
I was just going to say, if you're going to invest money in one thing to make your business successful, it would be hiring a payroll company. It's the cost of it is well worth the money. So that's all. Go ahead, Ian.
First question that came through there, what general ballpark of income for an S corp, meaning when I'm making approximately X amount, I should look into it? What kind of rule of thumb do you have?
It's about $45,000 to $50,000 of net income. That is where the sweet spot is for when the benefits for being able to manipulate the Social Security and Medicare are going to outweigh the cost. So to have an S corp, you're going to have an extra tax return, extra books, extra bookkeeping, mostly the extra tax return. So, and if you were a sole proprietor converting to an S corp, you're required to pay payroll to yourself as a shareholder. So to have the extra cost of that payroll company, the extra tax return, you got to be making probably, $3,000 to $4,000. You'll have costs of about $3,000 to $4,000. So we need to make sure that we can have enough self-employment tax savings to cover that $3,000 to $4,000 and make it worth your while.
And that's and just clarification, that's an annual cost for those additional things that the taxes we're getting out of. So
you gotta have net income of a minimum of $45,000 to be able to get enough self-employment savings to cover that $3,000 to $4,000 in costs.
Cool, thank you. If there's more questions on that, ping them into the string here. Another question that came through. Do you have any recommendations on tax estimation tools? Looking for something to assist with estimating deductions / 401k contributions to save on taxes. So is there anything out there that shortcut that somebody not working with you, instead of email you and say, what's my estimate value of this, that they can kind of find something?
It's a really good question, and I've never honestly looked because I have tax software that does it for me. So let me see if I can come up with a couple of options. I'll email them to Ian after. I'll see if I can find something that's fairly robust that might be able to give you some ideas. We have a number of planning softwares, but they're all kind of proprietary in our,
Yeah, and it's kind of funky. Like I know I've seen some on like TurboTax and some of those that have like mostly designed for like a very generic W-2 income. What's your salary and benefits? And then here's what a 401k would save you on your tax return this year. But it doesn't, I haven't seen any. So if you do find something, that's awesome, but I haven't seen any absent a full planning software that will take into account phase outs and deductions and some of those other things.
Sure, but I'll see what I can find. I'll see if I can find something a little more robust. I'll send it to Ian and he can distribute that out.
Awesome. Thank you.
Yeah. Any other questions at the moment?
I think we're doing good.
All right. Kind of wrapping up this business owner column on this spreadsheet, we get questions all the time on what are some deductions that we should be thinking about as a business owner that are different than when we're an individual. And really the answer is if it sniffs or breathes of being related to your business, it should be a deduction. Mileage is a big one that people don't think about. Cars are an interesting thing. We can chat about a little bit. Auto is weird in that if you are a business owner, you can actually have your business buy a car. You can take the tax deduction for the purchase of that car, plus the gas and the insurance and all of the actual costs related to that. Or you can use mileage. So, and it's an either or, you have to pick when a new car comes into play, but you can pick either actual expenses like deducting the car and the gas or taking mileage. And the feds adjust that mileage rate every single year, kind of to factor in inflation and all of that. And so there's that 57 cents that it is this year per mile is supposed to have built-in depreciation and your fuel costs, your repairs and maintenance and all of that. It's all built into that 57 cents a mile. So if it's easier to take that for folks that drive a lot in their jobs, it's almost always better to take mileage. Realtors are an example. They may be driving 30 and 40,000 miles a year. And for them, it 100% makes sense to take, 57 cents a mile in lieu of just taking their gas and insurance and that sort of thing. So it kind of depends on your industry. But auto is a big one. We have a number of small businesses this last year that ended up with extra cash flow. They had PPP money or whatever it was and needed to figure out how to spend some money. And cars are always an interesting item that we can use for tax planning. If you buy a vehicle that's over 6,000 pounds, you can deduct it all in 1 year. So you can spend 100 grand and get 100 grand deduction. I always say, unless you're planning on buying a new car, you're still spending 100 grand to get a deduction, which may be a $30,000 tax savings for $100,000 cash outlay. So you got to think about, does it make sense? But if you're planning on doing it anyway, doing some tax planning with your advisor on putting it in the business or not, or taking mileage or not, should be a question that you should raise to them. One of the, go ahead.
A couple of quick questions. Another came through here. How does the working from home pandemic stuff, how does that change any of the deductions, ability to have deductions, home office type of stuff? So W-2 versus business owner, what's changed?
Yep. Nothing has changed on the W-2 side. The stinky part is, as an employee, you can't deduct anything related to your job. So, and that includes home office. So it makes no difference if you're working there, there's still no deductions at all for working from home, buying office supplies, any of that stuff, if you're a W-2 employee. It's always been in for businesses and is still in for businesses. So you can deduct home office if you're working from home and you own your own business and are self-employed. They have a couple of options that you can use. They have a new safe harbor, which you just take $5 a square foot for whatever your office square footage is, or you can actually prorate out all of the expenses and everything like you always used to be able to do on home office if you're self-employed. I do think that some of the Biden reform will probably put back in some of those employee expenses, those unreimbursed employee expenses that we have none of these days. So we'll keep an eye on those. It's definitely something to watch. In addition to that, though, even if they do come back, you still have to be able to itemize. And they would probably bring them back like they used to look, where there was a 2% income threshold before you got to deduct any of those employee expenses, meaning you have to get over a fence before you get any. And the fence was 2% of your gross income. So if you made 100 grand, you'd only be able to deduct expenses in excess of $2,000. I think that probably is going to be coming back, but we don't know yet. We'll see how that goes.
One of the other things that gets kicked around every once in a while comes across buying tax credits for business or for individuals. What are your thoughts on that? Buy-in discounts, basically.
I think that they have a place. They're good for tax planning, and if you're in a situation where you have a significant amount of income in a certain year, if it's a big hit type thing, we use it a number of times for people selling a business there, and they have a pretty significant tax problem coming down for just kind of a one-year deal. We'll buy some of those. We would consider doing some of the tax credits, some of the conservation easement credits, some of those kind of one-time deal things where you really need a fairly sizable tax deduction. The nice part about some of those is the cash outlay is a little bit less than the benefit that you're going to get. So you can get a fairly sizable benefit without a big cash outlay. It's a great planning thing, but I would typically use them in a situation where you've got a bigger income year or something out of the ordinary.
Cool, thanks.
What's your thought, Ian? When do you kind of see those happening with your clients?
Yeah, I don't mind them. It's typically that type of big outlier type of event. Like, we've got this coming. How do we create some, gimme somewhere else to, reduce the pain of that? So I wouldn't have it be a part of my every year planning probably, but if it's some big outlier event that takes me from 300 grand to 2 million, might look at something there, but.
That's right. That's when we see it too. I think some of the other things that we kind of see in those types of years, if anyone's got that coming, would be contribution planning, charitable contribution planning. I know if you are charitably inclined and you have a big year, we do a lot of planning around donor advised funds. Those are basically putting the funds into an investment account that is considered to be a 501c3, where you get a tax deduction for the charitable contribution in the year that you put that money into the fund. But then you can use the dollars in that fund in order to fund your charitable giving for many years to come, and it grows and earns income just like a regular investment type fund. You invest it like other kinds of cash. It leaves your estate. So it's one of those things that we use for estate planning, particularly for older folks that know they're charitably inclined and are going to want to do giving. You can get a pretty sizable tax deduction, charitably in 1 year, and then use those funds for a long, long time. So we use that quite a bit as well, which I'm assuming is something that you might have in your pocket, Ian, as well, to be able to do those investments.
Yeah, kind of depending on what the goals are and stuff like that, sizes and that sort of thing. But there's different values to different areas to take that money. Yep,
absolutely. It really only makes sense if you really are charitably inclined, which not everybody is, and that's okay. Kind of on this form, getting back, jumping over to that employee and W-2 filer column. I know the vast majority of folks in the world are in this column, and so kinds of some things to think about if you are not itemizing deductions is manipulating your spending during the year in order to try to itemize, meaning the main things right now that we have at our disposal to be able to take itemized deductions on your personal return are medical expenses, taxes, which right now are capped at $10,000, your mortgage interest, and your charitable giving. And so we do some planning here and there to use timing of these things in order to maybe itemize 1 year, take the standard deduction the second year. For instance, we've got people that do a lot of charitable giving, we will typically have them do 2 years worth of charitable giving in 1 year. Do it all on 12/31 of 2021. Get a pretty sizable tax deduction, itemize their deductions in 2021, and then next year they don't typically do much, if any, and we just take the standard deduction that year. What we want to do, because the standard deduction for a married couple is so high at $24,000 or $26,000, depending on your age, is we want to make sure we have enough deductions in 1 year to exceed that 26 by a pretty considerable amount. If you can't ever get over that $24,000 or $26,000 mark, then it's okay to take the standard deduction and roll with it. But
so a quick kind of expansion on that, not as a suggestion for anybody to do, but we've seen people or help people take some old highly appreciated stock options from their employer, gift them into a donor advised fund for 5 years of the future tithe to their church, and then they send, you know, either monthly or quarterly or annual distributions from their donor advised funds over to the church. So they're getting out of some taxes on the gains, they're getting a tax deduction for the contribution, and then they're also still giving it to the same place. They're just doing it out of a donor advised fund versus their checking account. And they end up with more money and less taxes because they just use that type of structure. So it doesn't have to be like a massive amount of money to really have an impact over time. But like you're saying, we can push a future budgeted expense that we know we're going to spend anyways into one tax planning year. So just kind of a little bit of a connecting the dots there for us.
100%. And that appreciated stock is huge. If you can get rid of the entire capital gain tax that you would have incurred if you had sold it and get a charitable deduction, it's that is close to double dipping as you can get. But that's a great idea if that's something that you got access to, is appreciated shares. Some of the state deductions, it's always important to think a little bit about the state if you're in states that are high income tax, like Oregon. So there is still 529 planning. So 529 plans are college savings accounts for your kids. It can be for adults. It doesn't have to be for kids. But college savings accounts that allow you to get a state tax deduction. In order to get the deduction in the state where you reside, you have to use that state's plan. So, and there's typically a fairly sizable brokerage house that runs the plan. I know Colorado is a Vanguard plan. I'm not sure what Oregon is.
Oregon is the MFS, and then Oregon College Savings State Plan, and each state will have their own different ones. But for those of you not in Oregon, a lot of the folks on the call looks like are not in Oregon. Different states like Texas doesn't allow the deduction of anything for a contribution to a 529. So if you wanted one, you could choose the Maryland plan if you wanted, because you liked Vanguard or Colorado or whatever. So doesn't mean to be that. Rules have changed on those plans recently to where you can use them for high school and middle school. But the impact on the 529 plans at college is it has a negative impact on your FAFSA form, having the money in the 529. So we got to make sure that we don't over contribute to the 529s and end up, you know, hurting ourselves college planning wise by over saving in a different infrastructure. So there's a balancing act we have to do in that, depending on where we're living.
Yep. And something coming down the pike on that too, if you are doing 529 savings, they're talking about capping it. Right now you can put in a lot if you wanted to. They're talking about capping it to $12,000 to $15,000 a year total for all of your accounts. So if you had 5 kids and you were doing 12 grand a piece, you're now capped at $12,000 total. So that's one thing that's actually behind the scenes in the Biden fund. So we'll see what kind of comes of that. We manipulate those a little bit too, because they only have to stay in that plan for a little while. So a lot of times for folks that haven't saved, we will use them for tax planning, for college planning when the kiddos are actually starting to go to school. We open one up, we throw their tuition in it for the semester, it stays there for 10 days and we pull it right back out and we pay the tuition, but we get the state tax deduction. So we kind of use those, but on that note, it also doesn't affect the FAFSA because it's not sitting there, as part of your assets when they're calculating your family contribution to your state tuition. So just some things thoughts to put in your head on things to ask about if you have college age kiddos. Um, we get questions a lot on how do I manage tax withholding so I have enough, but not too much. Some of you probably figured out and hopefully didn't get hurt too badly, but a lot of people did, is they changed the W-4 form, which was the form when you were an employee, on how to tell your employer how much to take out of your account for federal and state tax withholding out of your paycheck. When they changed that form, the formulas got super weird. And instead of using brackets and that sort of thing like they used to do, they basically said, we're going to calculate it based on your annual income. So if you make $50,000, we are going to assume that you're in the 10% tax bracket, and we're going to pull out 10% of that $50,000. The pain point came because your employer only knows about that $50,000 that they're paying you, but they don't know that you have $200,000 of rental income, and that your wife works and makes 500 grand in her W-2 job. And there was no way in order to figure out, employers to figure out what those numbers were. And so for the last couple of years, we've had a number of people that have not had anywhere near enough withholding on their W-2s because they had typically had way more coming out. That's on my team. They had more coming out in prior years, and then all of a sudden they were used to getting big refunds. The big refunds weren't coming, or they just didn't have enough paid in to even cover their W-2. So there is a calculator on the IRS website, irs.gov. It's a W-4 calculator where you can go in. It takes forever. It's probably a 30-minute process, but you can go in and put in all of your detail, all of your spouse's detail, and walk through the calculations. How many kids do you have? How much charity do you normally do? And it'll give you a really good idea of how much tax withholding you have to have on the federal side to make sure that you're covering all of the income and everything that's on your tax return. You can then take that number, whatever it tells you, and then if your employer is not doing enough, you can go back to them and say, I want to do $200 extra per paycheck or something like that to get to that number that has been calculated on the IRS website. So if you have been kind of affected by that pain piece of things, it would probably be worth your time to go walk through that calculator. Most states, the vast majority of states are a flat rate. And so they factor in what your federal taxable income is, multiply it by a flat rate. Some states have brackets that you'll go up, but you can kind of just say, hey, this is normally my net federal income for the year multiplied by your tax rate. And that should give you a good idea on the state side. So it doesn't have to be too much brain damage
Perfect.
on the state side of things.
Question came through back to donor advised funds real quick. And I know the answer, I think, but I'm going to let you deal with it. Are there any restrictions to the charities that donor advised funds can contribute to?
No, but I'll caveat that a little bit. So no, as long as it's a 501c3 entity, charity, then the donor advised funds can send funds to those charities. I will caveat it in that if you choose certain donor advised funds, for example, there's a big one, National Christian Foundation has a DAF that you can contribute into, and they control what kind of entities you can then divvy out your money to. It has to meet with their guidelines and their mission statements and that sort of thing. So you couldn't contribute to Planned Parenthood, for instance, out of National Christian Foundation DAF. And so it's more who's holding those funds, and if there are some restrictions under that specific fund. If you just do a regular, go ahead.
Yeah, for the most part, like a Charles Schwab or TD Ameritrade or any of those, they're going to just have an open door to any 501c.
You can do anything you want as long as it's a 501c3 entity.
Yep.
You got it. Anything else?
I don't think so for now.
All right. So next slide, just a couple of things to think about before year end 2021. Charitable giving, if it's something that you do regularly, they have to be done by 12/31 every year to count for the year. You may have noticed last year on your tax return, if you did not itemize your deductions, you got a credit of $300 for doing charity over and above the standard deduction. That is moving up this year. It'll be 300 for a single person, 600 for a married couple. So even if you take the standard deduction, you can, I would suggest doing a little bit of contributing somewhere. You can get that $600 deduction on top of your standard deduction.
Is donating clothes and toys to Goodwill count for that $300?
It does not. It actually has to be cash. So non-cash donations do not qualify for the $300 and $600 pieces. Good question. There are many states that actually will do a charitable contribution deduction, even if you're taking a standard on the federal side, you can still get them in your state. So that's something to keep an eye on too. But those also have to be cash. On the business side of things, again, just planning with your advisor on how to maximize deductions. If you have heavy cash flow or are having a good year, is it a year to buy equipment? Do you need a new car? Is there extra cash at year end to maybe establish a retirement plan? The cool thing about retirement plans is you can set them up to where the cost on the employer side is not that onerous. You can have just employees putting their money in. You don't necessarily have to put employer money in if you don't want to, but you can. The more employer money you put in, generally, the more money the employer, is you, the business owner, can contribute yourself. So sometimes it makes sense to have a contribution going in. Right now, we're in a situation where we have bonus depreciation available for businesses, meaning that right now, up to 100% of your purchases for equipment, furniture, fixtures, and those kinds of things are 100% deductible in the year of purchase. That is remaining through 21 and 22. And then in 2023, that number drops to 80% bonus depreciation. All that really means is you'll get the first 80% up front when you purchase it in 2023, and the remaining 20% of that cost will be depreciated over the life of the assets. So we have a little bit of a boom. They're trying to, incentivize spending right now, so you can deduct everything. Depreciation comes into play whenever you purchase an asset in excess of $2,500. So $2,500 is the current threshold. So anything under $2,500, if you go buy a desk or a chair or whatever, we don't care about that stuff. You can just put it into office supplies. These things only come into play when it's stuff that you're purchasing in excess of $2,500 per item. That's something to think about. One thing that we use a lot is the charitable IRA exclusion. Again, if you're doing charity anyway and you are of RMD age and you're required to take a required minimum distribution out of your IRA, we get questions all the time like, I don't need this money to live on, and it really ticks me off that I have to take it out of my account and spend it and pay the taxes on it. So we have a number of folks that will use this. If they're taking their required minimum distribution up to $100,000, you can donate to a charity, and it keeps your IRA RMD from being taxable income to you. You do not get an additional charitable contribution on top of that. It just basically turns the IRA into a non-taxable withdrawal. So it's something we use pretty regularly. It is still in place probably for the next couple of years. I haven't heard any inklings.
That's nice. And that can be really nice because it can keep your pension income and Social Security income out of different thresholds and not have an escalating tax burden. So like that. Quick question for you that came through, two of them actually, they're firing off now. If I could do a charitable gift that could be from the personal side, if I could do a charitable gifting that could be from the personal side or the business side, personal up to 600 and then have biz do the rest beyond that, does that make sense?
It's a thought, but it doesn't work. The reason being is that all of that charitable giving, whether it's business related or personal, all flows down into your personal return, unless you're a C corporation. If you're a C corporation, C corps can deduct their own giving. Most small business is not. So if you're an S corp, a partnership, a sole proprietor, all of that charitable giving is going to flow down through to your personal return, and then you still got to have enough to be able to get you over that itemized deduction limit to be able to itemize. So it doesn't matter whether you make it personally or business wise, it's all going to the same spot.
Next question. Sorry, we're almost up on time too. So We'll just hit a couple more questions, let you have some final thoughts, and go another 2-3 minutes here. But say the business owner buying a vehicle, can it be mixed personal and biz, or does it have to be biz only? Should biz buy it, lease it? Should the person buy or lease it to the biz?
Yes, yes, and yes. So personal use always comes into play. And it comes into play differently as to whether you purchased it or you're leasing it to the business. So the business can purchase the car, they can pay all the expenses. The rule is that you're supposed to figure out how much of all the costs was personal usage during the year and take whatever that dollar amount is and put it on your W-2 as benefit payment. If your company leases a personally owned vehicle, you can pay a lease payment to the owner and still deduct the gas and the insurance and all of that stuff. Same thing, we figure out how much of that lease was personal use, and then you're supposed to bring in that personal use of auto income onto your tax return. So you can do it either way. You'll always have a little bit of personal income coming back for whatever you're using that car for personal, one way or the other, but they work differently depending on how you're treating that car.
Perfect. Sounds like they need to talk to you.
There you go. Well, that was my last slide. So this is my contact info. And if you have any questions, feel free to reach out to me directly. Email me a question and I'll try to get back with you. I'll try to connect with Ian and see if I can come up with a planning software option and send that to him.
We have one last question that I want to know the answer to as well, before we get out of here. Have you heard anything about getting rid of step up and basis rules?
Yes. So the original Biden reform had elimination of step up and basis altogether. It was just going to go away. And there was so much pushback already. There's lots of screaming and crying about that one. And so they've adjusted it a little bit, moved the needle down to $1 million again. So the current proposal as it stands potentially would allow you to get step up in basis of up to $1 million in assets and appreciated property, and anything in excess of that $1 million would be subject to capital gain tax immediately at date of death. So that could be a big one. There's two caveats to that. They're talking about making personal residences, doing an allowance for personal residences. So if you inherit the family home, it may be $250,000, $500,000 of additional. And then there's some weird calculations on family businesses. So trying to allow for passing the family farm or passing the family business where the children work, and giving a little bit of leeway there so that they wouldn't have to go sell the land to pay the tax bill kind of thing. But the rules are really limited, and the children inheriting that property actually have to be involved in the farming, be involved in the business, that sort of thing. So that one is a big one on the estate side of things. And that'll kind of require some additional estate planning if that one goes through as well. Hopefully it can come off the block. That one's a painful one.
Yeah, for sure. Cool. Well, thank you, Katie. We appreciate your time. We appreciate all the information and spending your day with us. So thank you. And if anybody has any questions, again, Katie's awesome. We have clients from all over the country that work with her. And she is awesome, incredibly responsive, and a super good resource to all of us. So thanks for coming.
Thank you. I appreciate having me.
All right, guys. Thanks everybody for joining. We're gonna sign off and get on with our days. Thanks.
Thanks so much.